Okay, hey, welcome folks to another training video in this free course series. And in today's video, we are going to cover buying versus selling options, okay? And we're going to analyze some of the differences. This will be a pretty quick video, but it'll give you the kind of the basics to go by. So let's look at buying options first. So let's remember our basics here. When we buy an option, this gives us the right, but not the obligation to buy or sell a security at a specified price on or before a given date. Okay. Now, in my opinion, buying options is the strongest position. And the main reason it's the strongest position is because you have rights. You are not obligated to do anything with that option. Now, one of the downsides to buying options is it does require a directional bias. So you have to know what you're expecting that security to do. Okay, and then when you buy an option, your risk is defined and capped. Okay, once you buy that option, that is your risk. You cannot lose any more money than what you've already paid for the option. The really cool side about buying options is your returns are often infinite. And I'm gonna show you. We're gonna go over to the broker platform after, and I'll show you some examples. Now let's look at selling options. So looking at our basics here, when you sell an option, you are obligated to buy or sell a security at a specified price on or before a given date. Now, in my opinion, selling options is the weakest position, and the main reason is that big different word in there called obligated. This means that at any given time during the life of the contract, you could be obligated to do something, and in many cases, when you're obligated to do something after selling an option, it's not what you wanted, okay? This means that you can be assigned at any given time within the specified contract period. Okay, there's only one option that doesn't do this, and that's SPX. Outside of that, I don't know of any other option that settles at the end and won't be early assigned. In every other instance, whether you're doing Apple or SPY and ETF, you can be assigned at any given time. You could literally be assigned moments after you sell that contract. Okay, so it's one of the things you have to be cognizant of. Now, when you sell an option, your risk is defined, but it's not always capped, and I'll show you why that is. The way we show our members in the Options Wealth Academy, your risk is capped as long as you manage the trade properly. However, there are times where you could get involved in a selling strategy where your risk could be infinite, and you never want that. The other thing is your risk or your return is defined and it's capped. When you sell an option, you know exactly how much you're going to make on that trade, the maximum amount of money you can make on the trade. You cannot make any more. Okay, so it's almost flip-flopped, and that's usually what the case is when it comes to options. Okay, so let's go over the pros and cons to buying and selling options, and we'll start with the buying side. So for the pros, the first thing is you have rights, not obligations. Remember, go back to your options basics when we talked about this. When you buy an option, it gives you rights, but you're not obligated to do anything. The second thing is the risk is capped and your return is often infinite. And basically, whatever you pay for that option, that's the most you can lose. So that's your risk. However, the stock can go up as high as it wants. So your return is infinite. And then you get to set the time and the risk, right? So you determine, okay, whatever your directional bias is, whatever option you're going to buy, you get to determine how long do I want to be in this option and how much do I want to risk of my account. And the time and risk are going to go hand in hand because your risk is often going to help determine that time frame. Now let's look at the cons. The first one is the security that you're buying the option on has to move in the direction you want it to. If it just goes sideways or even moves a little outside of your bias, so in other words, if you needed it to move up and it moves down, you're going to lose money. Okay. The other thing is time decay works against you, right? If we boil down option pricing into just two easy categories, intrinsic value and extrinsic. Extrinsic is the time. And each day that goes by, that value gets smaller and smaller, which means if the security doesn't move in the right direction, to increase your intrinsic value, the extrinsic value will work against you and kind of whittle away at the value of that option. And then I always consider buying options to be the riskiest strategy, even though you have rights and not obligations. It's the riskiest because they're often the most expensive when you look at it. And I'll show you when we go and look at some buying versus selling. But now let's look at the selling side. So the pros to the selling side is time decay is your greatest ally. Okay, remember that extrinsic value because you're selling now, you want time to tick away because you have to buy the option back to close the position. So if you sell it at a higher value and time ticks away and it gets less and less expensive, you can buy it back at a lower value and you make money. The other thing is you don't have to be perfect on your directional bias. You can actually be a little bit wrong depending on the type of option that you sell. And then the income is immediately deposited when you sell the option. You'll see your cash value of your account will go up when you sell that option. Okay. Now, the cons, you're now obligated. Okay. You no longer have rights. You are now obligated. And this will come into play if you sell an option and you're totally wrong on the directional bias. You do have to have some directional bias, but if you're completely wrong, you're now at risk of being obligated to do something. And then depending on the type of option that you sell, your risk can sometimes be infinite. Okay. And then the last thing is your return is capped. Okay. So you don't take as much risk depending on the type of option that you sell, but your return is limited. It's not infinite like you do have with buying. So let's go ahead and take a look at some examples of buying and selling. So let's go into our broker platform, okay? And I'm going to show you a couple of examples of buying and selling strategies. So here we have what's our 3x growth strategy. And I bought this trade literally 2 months ago, and you can see it cost me $3,700, but my return on investment is infinite. Right now, my return is at 2,300. It's at about a 70 or 62% return right now in just 2 months. So when you get your directional bias correct, these things really do pay off. And my risk is limited. My risk is capped, I should say. I can only lose $3,757. Again, remember the option basics. When you see a price on an option, you always have to multiply it times 100. One contract, unless it specifically states in the contract, every option contract represents 100 shares of the underlying security. So in this case, I have a 480 call option on SPY. It represents 100 shares of SPY. You can see my call option expires 19 December 2025, and the strike price is important because it equates to what the stock price is doing. Okay, and you can see this option is $2.64 in the money because SPY is at 482.64 and my strike price is at 480. So remember, go back to your option basics. What does this mean? If I were to get assigned, which I could only get assigned on this option if I let it go all the way to expiration and it's in the money because the option will be assigned, it's going to have me buy 100 shares of SPY at 480. But even if I got assigned, which I can't be assigned on this because remember, I own this option. I'm not obligated to do anything. But if I were assigned, I could turn around and sell the shares at 482.64. Okay, so that's basically what that means. Obviously, I would never do that. It would be much better to just sell the option and take the $2,300. Okay, so that's an option buying strategy. So let's look at an option selling strategy. I don't have any in this platform to show you, but I can easily show you what it looks like. Okay, so let's say we expect SPY to go up in price. So if we go back to our basics, we want to buy a call if we expect the stock to go up. So selling is going to be the exact opposite. We want to sell a put if we expect the stock to go up. Okay. That's a directional bias. So let's just say I take this 23 February. This is 30 days away. And I expect SPY to go up, but I'm just going to give it that way, right? So I sell this 482.50 put. When I sell this put, the broker is going to immediately deposit $562 into my account. Okay, and let me bring this over to this forefront here. This box is important. Okay, so you can see right here, max profit 562. No matter what SPY does, I cannot make any more than $562. Now notice my risk. My max loss is $47,688. So that's not very good, right? You don't want to risk $47,000 to make $562. But let me explain why the broker platform is doing that. The broker platform is showing you that if you were assigned and the stock or the security went to zero, you would lose $47,688. The reason for that is because they're taking that strike price of 482.50, okay, and they're multiplying it times 100, because remember, one contract represents 100 shares, so you would be obligated to buy $48,250 worth of stock. And if it went to zero, why does that number not match 47,688? Well, it doesn't, because you got a credit on the front end of $562. So now you can see your max loss would potentially be 47,688. Now, just a quick caveat here. I sell puts. I sell naked puts. I don't worry about this number because it's a potential, but it's not a likely. And to be honest with you, being on SPY, if SPY went to zero, I think we got bigger problems on our hands. And for those of you that are watching that happen to be in the military, you would know what I mean, right? And the least of our worries would be our money and the stock market at that point. You'd want to invest in brass. So anyway, but that's what it's showing you. So again, you can see, now do you see why I believe that buying options is a stronger position than selling options? Because I don't have to risk $47,000 to make $500. And if you look at my actual trade over here, I did not do that. If we go to my leap call here, I risked $3,700 to make a potential infinite profit. Okay, and I'll show you why that is. So let's say I buy this call option. Now, if I buy this call option, I am not obligated to do anything. I have rights. Okay, so if I were to buy this call option, let's look at our risk parameters. My max loss is $775 because the option costs $7.75. Multiply it times 100, $775. That's the most I can lose. I cannot lose any more. Look at my max profit. Infinite. It means that if SPY goes to $600, this option is going to be worth a ton of money. The broker platform doesn't know what my max profit is because my max profit could be infinite. Okay, it can just keep going up and up and up as long as the stock goes up and up and up. Okay, now let's go back to our selling strategy, and I want to show you why you do not have to be perfect on your directional bias. And in some cases, you don't really have to know the direction or pick a direction. So let's take this same put that we were selling. Now, puts will profit when the market goes up. Puts will not profit when the market goes down. They'll get more expensive and you'll either be assigned or you'll have to buy it back at a loss. But if I were to take, let's go out to a 7-day, I can't find a 7, so we'll use a 6-day option. The market has, let me pull up the chart of the market, SPY. We're going to use SPY. Look at how SPY on Friday just jumped in price. Now, I don't believe that SPY can sustain that move. I believe it's going to come back. But let's suppose that my bias is somewhat correct, that SPY will come back and then continue to go up. And I believe it'll come back no more than the 7-day moving average. Let's say I believe that in the next 6 days. And I could be wrong, but let's say I believe that. So if I go to my chart again, that's 476.53. So we'll just choose 477. That's closer to 476.53. So if I sell this 477 put and the market moves down a bit, let's say the market's at 482. So let's say the market moves down to 479 in the next 6 days. I will keep all of this. So let's hit the confirm and send, and let me show you what that looks like. Again, my max loss is still 47,000 because remember, I'm on the hook to buy SPY shares. But my max profit is capped. But I can literally make $78 in just 6 days if I'm right. And if I'm a little bit wrong, I can still make the $78. I will keep all of this credit as long as SPY stays out of 477. Okay? So that's the difference between the selling strategy and the buying strategy. Now I'm going to take it one step further and just show you kind of how we do it in the Success Academy. We don't sell necessarily, as a matter of fact, in OWA 1.0, we don't sell puts. We sell a combination. And what that is called a credit spread. And so in my same example there, you can see, now I'm not going to make as much, but we want to make $78, right? So I've got to do 6 of these contracts at least. So let's do actually 5 times 4. That would be close. That'll be $70. Let me show you the difference on what we do. So same risk parameters, right? I need SPY to not move down to 477. And if my directional bias is a little wrong, I'm okay because right now SPY is at 482. So I'm going to get the same credit roughly, right? $70, but look at the difference in my risk. My max risk is now capped at $430. Okay. So this is an example of how risk can be capped on a credit or on a selling strategy. So again, my profit is capped, but my risk is also capped. Okay. So in 6 days, if the market does move into my price, the most I can lose is $430. That's it. So that's the beauty of the selling strategy we teach. Now, let me show you a different approach that people actually do this. It's called selling naked calls. And this is something I would never do. So again, in this case, we're going to sell a 483 call option. Now, remember, everything's opposite in selling strategy. So we do not want the market to move up. If the market moves up, we are going to lose money. We want the market to move down. So in this case, let's say looking back at that chart, we were like, okay, there's no way it can sustain this. And I believe over the next 6 days, it's going to come back to its 30-day moving average. So we turn around and we sell an at the money call option. We don't own the shares. Remember, this is now going to obligate us to sell someone shares. We don't own them. Okay. That's why this is such a risky strategy. I'm going to bring it up over here. Notice my max profit is capped at 255, but look at my loss. My loss is infinite. And it's infinite because if the broker doesn't know what SPY can be at on that day. And if you're assigned, your max loss is going to be based on where it's at. So for example, I have to sell SPY. I'm obligated to sell SPY at 483. I do not own the shares, which means on expiration, if I get assigned, I'm first going to have to buy the shares and then sell them. And then to make matters worse, if there was any dividend, I have to pay the dividend out too. So that's why this is a very risky strategy, extremely risky. And anytime you do a strategy where your max loss is infinite, you should look to not do that strategy. Now, I will show you one other thing here. I don't know if let me see if I own shares Yeah, I don't. But if you did own shares of a stock, so let's say you owned 100 shares. I don't own any in here, but let's say I did own 100 shares of stock and I sold a call option against that stock, it would still show that infinite loss, but it's not because I already own the shares. Sometimes the broker platform just doesn't recognize that. But if you notice, this is a paper trading and you notice I'm on IRA. So it wouldn't even let me do this because you can see I don't own the shares because actually it is letting me doing it and it shouldn't. Oh, I know why it's letting me do it because I have the cash available. So let me show you when it wouldn't. So let me do 3 contracts. See how it says illegal 100 shares? It says it 3 times. It's because I don't own the shares and it's an IRA. It won't let me do it. Okay. So you can't sell naked call options in an IRA if you don't have the cash to cover the transaction. Okay. So that's it, you guys. That is really the difference between buying and selling. I don't subscribe to either or camp. I subscribe to both. I love selling options. I love buying options. I am not biased one way or the other. There are some people that you'll hear this a lot of more option traders are negative against buying options, and they will tell you why selling options is the best strategy. For me personally, and from my experience, they're both great strategies. Selling options takes a little bit more work, and buying options is almost passive, especially the way we do it. As you can see here, I have an option. I bought it, and I just wait for, you can see my good till canceled order up here. When that option gets to $74, the broker platform will automatically sell it out, which means I generated a 100% return on this trade. So that's why I love buying options, because it's such a hands-off approach. I don't really have to do a whole lot to manage it. And when it goes my way, it's fantastic. So that's it, you guys. You take care. We'll see you in the next video. Bye-bye.